Before we dive in, please remember that this video is for informational and educational purposes only. I am not a financial advisor, and the content of this presentation should not be considered financial, legal, or tax advice. The mortgage and housing markets are complex and highly personal. Always consult with a qualified professional, like a licensed mortgage originator or financial planner, before making any decisions based on the information you see here. Your financial situation is unique, and you need advice tailored specifically to you. You did everything right. Back in 2020 or 2021, you saw your shot and you took it. You jumped into the chaotic housing market, fought off a dozen other offers, and you won. You landed your dream home, and more importantly, you locked in a mortgage rate that now feels like a myth, a legend whispered around campfires. 2.7%, 3.1%. You felt like a financial genius. You were set for life. And then life happened. You got a promotion in another state. Your family grew, and the walls of your dream home started closing in. You need to move, but you can't. You are a prisoner in paradise, shackled by a pair of golden handcuffs. This isn't just a story. It's the defining economic reality for tens of millions of American homeowners right now. And if you don't have one of these golden handcuff mortgages, you're still feeling the effects every single day, because it's warping the entire U.S. housing market into something we've never seen before. Consider this staggering fact from the Federal Housing Finance Agency. More than 60% of all active mortgages in the United States have an interest rate below 4%. Let that sink in. The majority of American homeowners are paying a rate that is literally half, or even less than half, of what's being offered today. So, what happens when nobody wants to sell? What happens when the normal churn of the market, people moving up, downsizing, relocating, grinds to a halt? You get a nationwide inventory crisis. A paralysis. Sellers look at today's 7% rates and say, "No thank you. I'm not giving up my 3% loan to pay double for a new one." And potential buyers, especially first-time buyers, look at the few houses that are for sale, see the sky-high prices combined with those crushing interest rates, and they feel hopeless. It's a standoff, a Mexican standoff where buyers, sellers, and the market itself are all pointing a finger at each other, and nobody can make a move without getting hurt. This is why the old rulebook for buying and selling a home has been thrown out the window. The advice your parents gave you, the strategies that worked for the last 50 years, many of them are now dangerously outdated. Simply getting a 30-year fixed-rate mortgage is no longer the default, foolproof answer it once was. The game has changed. The board is different. The pieces are moving in ways we haven't seen in generations. And in a changing game, the person who understands the new rules is the one who wins. That is the entire purpose of this video. We are not here to just report the news or complain about high rates. We are here to hand you the new rulebook. Over the next 10 parts, we are going to dissect the modern American mortgage market and give you a strategic playbook to not just survive, but to thrive in this unprecedented environment. We are going to pull back the curtain on the trends that are quietly reshaping homeownership in America. This isn't just about interest rates. It's about the fundamental shift in the products being offered and the creative strategies being used to get deals done. We will demystify the adjustable rate mortgage, or ARM. For years, it was a four-letter word, a relic of the 2008 crisis. But the ARMs of today are a completely different animal, and for the right buyer, they can be a powerful tool to unlock affordability. We'll show you exactly how they work, who they're for, and the critical questions you must ask to avoid the risks. We're going to break down the explosion of mortgage rate buydowns, the 2-to-1 buydown, the 3-to-1 buydown, where sellers are literally paying to lower your interest rate for the first few years. It sounds like a gimmick, but it's one of the single most popular strategies in the new construction market, and it could save you thousands of dollars when your cash flow is tightest. Is it a smart move or a dangerous trap? We'll give you the framework to decide. We'll explore the hidden world of assumable mortgages, a nearly forgotten option where you can literally take over the seller's existing loan, complete with their rock-bottom interest rate. Imagine buying a home today and inheriting a 2.9% mortgage. It is possible. It's happening right now with FHA, VA, and USDA loans, but almost nobody knows how to do it. We'll walk you through the process, the pitfalls, and how to find these unicorn properties. We will also dive deep into the new wave of creative financing, seller financing, contract for deed, and the rise of fractional ownership companies. We'll look at how the big banks are changing their lending standards, what's happening with jumbo loans, and how the government is trying to step in to ease the affordability crisis. This is not a theoretical discussion. This is a practical guide. Whether you're a first-time homebuyer feeling locked out of the market, a current homeowner feeling trapped by your golden handcuffs, or a real estate investor looking for an edge, this video will provide you with the clarity and confidence you need. The housing market paralysis has created a fog of confusion and fear. But within that fog, there are new paths, new opportunities, and new ways to achieve your goals. You just need the map. And that's what we're here to provide. We're going to cut through the noise, ignore the fear-mongering headlines, and focus on the actionable strategies that are working in the United States mortgage market right now. The landscape has changed, and it's time your strategy did too. So let's start by understanding the single biggest force that got us here: the lock-in effect. Why does it matter so much, and what does it mean for the future of home prices? The answer might surprise you. The lock-in effect is the most powerful, least understood force in housing today. Think of it as a pair of golden handcuffs. The golden part is that incredible 2.7 or 3.2% interest rate you, or someone you know locked in back in 2021, feels like winning the financial lottery every single month. The handcuffs part is the chilling realization that if you ever sell your home, you have to give up that rate forever. You can't take it with you. You have to trade in your golden ticket for whatever the market is offering today, which feels less like a ticket and more like an invoice. And this isn't some niche phenomenon affecting a few lucky homeowners. It is the defining feature of the entire market. The scale is colossal. According to data from the Federal Housing Finance Agency and other top analytics firms, the numbers are staggering. Roughly 80% of all U.S. mortgage holders have an interest rate below 5%. Let that sink in. 8 out of 10. Gets even more dramatic. Nearly 60% of homeowners are sitting on a rate below 4%. And the real lottery winners? The nearly 1 in 4 American homeowners with a mortgage rate below 3%. This isn't just a market trend. It's a fundamental restructuring of household balance sheets for tens of millions of families. During the pandemic and the years of near-zero interest rates, America went on a refinancing spree of historic proportions, effectively locking in the lowest cost of housing debt in history. But what was a brilliant financial move then has now become a powerful anchor, holding people in place. To understand why, let's move away from the percentages and talk about a real-world scenario. Let's imagine a couple, we'll call them Mark and Sarah. In 2021, they bought their first home, a nice 3-bedroom, for $450,000. They put down $50,000 and got a $400,000 mortgage at a fixed rate of 2.9%. Their monthly principal and interest payment is about $1,669. Life is good. Fast forward to today. They've had another child, and Mark's job is now permanently remote, so he needs a dedicated home office. That 3-bedroom house suddenly feels like it's bursting at the seams. They need more space. So they start looking. They find a larger 4-bedroom home in a slightly better school district for $600,000. They've built up some equity in their current home, so after selling it, they figure they'll need a new mortgage of around $500,000. They go to a lender and get the shock of their lives. The best rate they can get today is 7%. Let's do the math on that. A $500,000 mortgage at 7% has a monthly principal and interest payment of $3,327. Their payment would more than double. It would go from under $1,700 a month to over $3,300 a month. That's an extra $1,658 out of their bank account every single month. That's nearly $20,000 a year. That's a new car payment plus a family vacation plus college savings gone. Just gone. And for what? For one extra bedroom and a home office. So Mark and Sarah sit down at their kitchen table, look at their budget, and make the only rational choice they can. They're staying put. They'll turn the dining room into an office. The kids will share a room for a few more years. They will make it work. Because the alternative is financial devastation. Now, multiply that exact conversation by millions. That is the lock-in effect in action. It's a math problem being solved at kitchen tables all across America. And the answer is almost always the same. Do not move. This personal, rational decision, when made by millions of homeowners simultaneously, has a catastrophic effect on the housing market. It single-handedly creates an inventory crisis. The homes that would normally be coming up for sale, the starter homes of growing families like Mark and Sarah's, are being held off the market. Potential sellers are becoming permanent residents, not by choice but by financial necessity. This is why you drive through neighborhoods and see so few for sale signs. It's not a mystery. It's the lock-in effect strangling housing supply. Normally, about 4 to 5 million existing homes are sold each year in the US. But the lock-in effect has vaporized a huge chunk of that. We're seeing inventory levels for existing homes at multi-decade lows. Now you might be thinking, okay, but high interest rates also crush demand, right? So it should balance out. And that's the conventional wisdom. It's what every economics textbook would predict. But this is where the story takes its surprising turn. While demand has certainly cooled from the frenzied peaks of 2021, it hasn't disappeared. Far from it. Life goes on. People still get married. They still have kids. They still get new jobs in different cities that require them to relocate. The largest generation in US history, the millennials, are in their prime home buying years. There is a baseline level of organic, unavoidable demand that always exists. So you have this group of motivated, have-to-move buyers who are now forced to compete for a historically tiny pool of available homes. It's a brutal game of musical chairs where 70% of the chairs have been removed from the room, but the number of players has only dropped by 30%. What happens in that game? A frantic scramble for the few chairs remaining. This is the paradox of the 2024 housing market. The very same high interest rates that were supposed to cause prices to crash are actually helping to keep them afloat. The impact of high rates on crushing supply has been far more powerful than their impact on reducing demand. The result is a stalemate. Prices aren't crashing. In many major markets, they're stable or even ticking upwards. The lock-in effect has created a price floor that is far more resilient than anyone anticipated. It has bifurcated the market into two distinct, separate worlds. In one world, you have the mortgage haves. These are the existing homeowners with sub-4% rates. They are sitting on record levels of home equity, their housing costs are fixed and low, and they are largely insulated from the affordability crisis. They are living in their own private economic boom. In the other world, you have the mortgage have-nots. These are the first-time buyers, the renters who want to own, and the relocators. They are facing the full brutal force of 7% rates, high prices, and impossibly low inventory. For them, the dream of homeownership has never felt more distant or more punishing. This isn't just an economic trend. It's creating a new form of social and financial stratification. The golden handcuffs are protecting the insiders while building a fortress wall around the market that keeps outsiders from getting in. So, if selling and moving is a financial non-starter for tens of millions of people, what happens next? Do they just stay in homes that no longer fit their lives forever? Not exactly. People are incredibly resourceful. They are adapting. They are finding a third way to solve their housing problems. A strategy that doesn't involve selling their current home or buying a new one. And this powerful adaptation is quietly fueling a multi-billion-dollar boom in a completely different corner of the housing economy. One that could represent one of the smartest real estate plays for the rest of this decade. And that play, that multi-billion-dollar boom, isn't happening in the Zillow listings or at open houses. It's happening inside the four walls of the homes people already own. We are in the middle of the Great American Renovation, a massive under-the-radar shift in how Americans are interacting with their single largest asset. Instead of moving up, they are building out. Instead of buying bigger, they are improving better. The lock-in effect we talked about, those golden handcuffs of a sub-4% mortgage, haven't frozen the housing market. They've simply rerouted the river of money. The desire for a better living space, for a home that fits a new lifestyle. A home office, a bigger kitchen, an in-law suite. That desire didn't just vanish when rates hit 7%. It's a fundamental human need. But now, instead of that money flowing to real estate agents and moving companies, it's flowing to contractors, lumberyards, and appliance manufacturers. Think about it like this. For decades, the American dream was a ladder. You buy a starter home, build some equity, and then you sell it to climb to the next rung, a bigger house in a better neighborhood. But what happens when the next rung is suddenly twice as high and coated in grease? You stop climbing. You look at the rung you're on and you decide to make it the best damn rung it can possibly be. You reinforce it, expand it, and polish it until it shines. That's what millions of American homeowners are doing right now. They are transforming their current home into their forever home. Not out of sentiment, but out of sheer economic necessity. And this transformation is being financed by a powerful and often misunderstood financial tool that is surging in popularity. The home equity line of credit, or HELOC. This is the hidden engine driving the renovation boom. While the mortgage application market for new home purchases has slowed dramatically, the market for tapping into existing home equity is on fire. A HELOC is essentially a second mortgage, but it acts more like a credit card. The bank looks at how much equity you have in your home. That's the difference between what your home is worth and what you still owe on your primary mortgage. They then approve you for a line of credit, say $100,000 secured by that equity. But here's the key difference. You don't get a lump sum of cash. You get a checkbook or a debit card, and you can draw funds as you need them up to your limit for a set period of time, usually 10 years. You only pay interest on the money you actually use. So for the homeowner who needs $50,000 to remodel a kitchen, they don't have to borrow the full amount on day one. They can pay the designer, then a month later pay for the cabinets, then pay the contractor as the work gets done. It's flexible. And while the interest rates on HELOCs are variable and higher than those old-school mortgages, they are almost always significantly lower than personal loans or credit cards. For a homeowner sitting on a 2.9% primary mortgage, taking out a HELOC at 9% to fund a value-adding renovation makes infinitely more sense than selling their house and taking on a brand new 7% mortgage on a much larger loan amount for a different house. It's the lesser of two evils, and in this case, it's a very, very strategic evil. The scale of this shift is staggering. As of early 2024, American homeowners are sitting on over $30 trillion in home equity. Let me say that again, $30 trillion. Of that, an estimated $11 trillion is considered tappable, meaning it's equity that homeowners could borrow against while still maintaining a healthy 20% equity cushion in their homes. This is the largest mountain of household wealth in human history. It's a vast private reservoir of capital, and right now the spigots are opening. Major banks are reporting double-digit growth in their HELOC originations. In the last year alone, homeowners have extracted hundreds of billions of dollars of equity from their homes, and the vast majority of that money is being funneled directly back into the property that secured the loan in the first place. We're talking about a level of home improvement spending that dwarfs what we saw even during the post-pandemic housing frenzy. Let's make this real. Meet Sarah and Tom. They bought their house in 2019 with a 3.1% mortgage. They now have 2 young kids, and Tom works from home full-time from a makeshift office in the corner of their bedroom. They're bursting at the seams. In a normal market, they'd sell and buy a bigger place. But today, the 4-bedroom house down the street they've been eyeing would take their monthly mortgage payment from $2,400 to nearly $5,000. That's a non-starter. It would cripple their finances. So they look at their own home. It's worth $600,000, and they only owe $250,000 on their mortgage. That's $350,000 in equity just sitting there dormant. They get a quote to finish their basement. Add a proper office for Tom, a playroom for the kids, and a new bathroom. The cost? $80,000. They go to their local bank and get approved for a $150,000 HELOC. They draw the $80,000 they need over the course of the 3-month project. Their primary mortgage payment of $2,400 doesn't change a bit. They now have an additional interest-only payment on their HELOC of about $600 a month. So for $600 a month, they've effectively gotten the bigger house they needed, without giving up their lottery ticket mortgage rate. They solved their space problem for a fraction of the cost of moving. But here's where it gets even smarter. This isn't just about comfort. It's about manufacturing wealth. That $80,000 basement renovation doesn't just add $80,000 to the value of their home. A well-done project like that, which adds functional living space, can have a return on investment well over 100%. A new appraisal might come back showing their home is now worth $700,000, a full $100,000 more than before the project. They spent $80,000 to create $100,000 in new equity. They literally turned their home into a wealth-generating machine, all while the broader market was essentially gridlocked. This is the real play. It's an active strategy in a passive market. Millions of homeowners like Sarah and Tom are using this exact playbook, leveraging locked-in, low-cost debt from their first mortgage to fund high-return investments in their own property, financed by flexible, accessible capital from a HELOC. It's a brilliant financial jiu-jitsu move, using the market's own weight against itself. This trend is fundamentally reshaping neighborhoods, the construction industry, and the balance sheets of America's biggest banks. It's creating a powerful economic engine that runs almost entirely on home equity. But this rapid expansion of secondary debt, of layering new loans on top of old ones, is not without its risks. It introduces a new layer of complexity and a new vector of potential instability into the financial system. Because while everyone is focused on the front door of the housing market, the buying and selling, This massive multi-billion-dollar backdoor boom is creating a hidden world of debt that regulators are only now beginning to scrutinize. And what they're starting to see is raising some serious red flags. So what are these red flags? What is this shadow system operating just beneath the surface of the familiar world of brick-and-mortar banks? The answer lies in a single seismic shift that has completely redrawn the map of the American mortgage industry. To understand it, we have to go back to the smoking rubble of 2008. After the great financial crisis, Washington's response was swift and, in their view, decisive. They passed the Dodd-Frank Act, a colossal piece of legislation designed to chain down the too-big-to-fail banks. The goal was simple: prevent Wall Street from ever again gambling with the housing market and, by extension, the entire global economy. The new rules were suffocating by design. They forced big banks like Wells Fargo, Bank of America, and J.P. Morgan Chase to hold vastly more capital in reserve for every mortgage they issued. Think of it like a financial seatbelt. For every dollar they lent out for a home, they had to keep a significant chunk of their own cash locked away, just in case that loan went bad. This made mortgages, especially those to less than perfect borrowers, far less profitable. It made the entire business slower, more cautious, and a lot more expensive for the banks to operate. And for a while it worked. The big banks pulled back. They retreated from the mortgage market, focusing on safer, more lucrative ventures. But here's the thing about money and about markets: they abhor a vacuum. The demand for mortgages didn't disappear. Millions of Americans still wanted to buy homes. So, as the giants of banking were forced to the sidelines, a new group of players rushed onto the field. They are called non-bank lenders, or shadow banks. And you've probably heard their names: Rocket Mortgage, loanDepot, United Wholesale Mortgage. They weren't subject to the same punishing capital requirements as the big, federally insured banks. This was their superpower. They could operate on razor-thin margins, move faster, and take on risks the big banks no longer could or would. And they didn't just step onto the field, they took it over. In 2010, just after the crisis, the big banks still issued about 3/4 of all mortgages in the United States. Today, that number has been completely inverted. Non-bank lenders now originate more than 70% of all new U.S. mortgages, and an even higher percentage, nearly 80%, of the government-backed loans from the FHA and VA, which are often the only path to homeownership for first-time buyers and those with lower credit scores. This isn't just a trend, it's a revolution. A quiet behind-the-scenes coup that has fundamentally changed who holds the power and the risk in the $12 trillion U.S. mortgage market. Now you might be thinking, so what? Who cares if my loan comes from Rocket Mortgage instead of Bank of America? A loan is a loan, right? On the surface, yes. For the individual borrower, the process might even feel smoother, faster, more tech-savvy. These companies are brilliant marketers. They've poured billions into creating slick apps and promising approvals in minutes. But the danger isn't in the individual loan. It's in the architecture of the entire system. Because these non-bank lenders operate on a completely different business model. It's a model built on speed and volume, not stability. Here's how it works. A traditional bank would issue you a mortgage and then hold that loan on its books for years, collecting your monthly payments. They had a long-term interest in making sure you could actually afford the loan they gave you. The non-bank model is different. They are originators, not holders. Their goal is to write as many loans as humanly possible, as quickly as possible, and then immediately sell them. They are mortgage factories, and their business is the assembly line. They originate the loan, package it up with thousands of other loans into a mortgage-backed security, and sell it off to investors, often within a matter of weeks. The vast majority of these loans are sold to two government-sponsored entities you've definitely heard of: Fannie Mae and Freddie Mac. This originate-to-distribute model creates a massive systemic game of hot potato. The non-bank lender makes its money on the upfront fees for creating the loan. Once they sell it, the long-term risk of you defaulting isn't primarily their problem anymore. It's Fannie and Freddie's problem. It's the investor's problem. And because Fannie and Freddie have an implicit guarantee from the U.S. government, if things go catastrophically wrong, it ultimately becomes the taxpayer's problem. The very risk that Dodd-Frank tried to push out of the big banks didn't disappear. It just migrated. It moved into the shadows, into a less regulated, less capitalized, and far more fragile part of the financial system. And these aren't small, niche companies. We're talking about giants. United Wholesale Mortgage, the nation's largest mortgage lender, wrote over $200 billion in loans in a single year. But their entire business model is predicated on a stable market, and the continuous ability to sell the loans they create. Unlike a massive bank like JP Morgan, they don't have a multi-trillion-dollar fortress of deposits and other assets to fall back on during a downturn. Their financial cushion is comparatively tiny. Regulators are worried about what's called a liquidity shock. What happens if the market for mortgage-backed securities suddenly dries up, even for a short time? What happens if investors get spooked by a recession and stop buying? The non-bank lender would be stuck holding billions of dollars in loans they can't sell. The assembly line would grind to a halt. And because they don't have the massive cash reserves of a traditional bank, they could face a cash crunch almost overnight. They rely on short-term lines of credit from, you guessed it, the big banks to fund their day-to-day operations. If those credit lines get pulled during a crisis, the whole house of cards could collapse with breathtaking speed. We got a terrifying preview of this in March of 2020. When the pandemic hit, the market for mortgage debt froze solid for a few weeks. Several non-bank lenders were pushed to the absolute brink of failure. They were making margin calls in the hundreds of millions of dollars, desperate for cash to stay afloat. The only thing that saved them was an unprecedented, multi-trillion-dollar intervention by the Federal Reserve, which stepped in and started buying up mortgage-backed securities on a scale never seen before, effectively becoming the buyer of last resort and liquefying the market. The system held, but only because of a massive, taxpayer-funded emergency bailout. The fire was put out, but the fire alarm was screaming, revealing a fundamental weakness at the very core of the modern housing market. So now we have a system where the majority of American mortgages originate from companies that are more vulnerable in a crisis and are critically dependent on government backstops to survive a downturn. The very entities created to absorb risk in the housing market, Fannie and Freddie, are now more exposed than ever, buying a torrent of loans from lenders who operate with a fraction of the oversight that traditional banks face. It's a paradox born from the ashes of 2008. In our effort to make the system safer by constraining the giants, we inadvertently created a new ecosystem of fast-moving, lightly regulated titans whose collapse could once again threaten the stability of the entire economy. This shift in who is lending the money is the silent earthquake that has reshaped the landscape. But it's only half the story, because this new breed of lender, in their relentless pursuit of volume and market share, has started to change the very nature of the product itself. The simple, 30-year fixed-rate mortgage is no longer the only game in town. To capture every possible borrower, from gig economy workers with fluctuating income to real estate investors juggling multiple properties, a whole new menu of creative, complex, and sometimes controversial loan products is emerging. So we have a new set of players dominating the game, operating with a different rulebook. But the real story, the one that affects you directly when you apply for a loan, isn't just who you're borrowing from. It's what you're borrowing. Because the very definition of a mortgage is starting to change, in ways that are both brilliant and deeply unsettling. Let's start with the classic American dream mortgage, the 30-year fixed-rate loan. It's simple. It's predictable. You borrow a lump sum, you pay it back with interest over 360 months, and the rate never changes. It's the bedrock of American homeownership. For generations, that was the deal. But that bedrock is fracturing. The new products emerging from the rubble are designed to solve one giant, overwhelming problem: the fact that most people can no longer afford the bedrock. The first, and perhaps most radical, innovation is the rise of fractional ownership mortgages. This isn't just a new type of loan. It's a completely new way of thinking about owning a home. Instead of buying a house, you're buying a share of a house. Imagine a company, a well-funded startup, comes to you and says, "That $500,000 house you want? You can't afford the 20% down payment of $100,000. We get it. So how about this? You put down what you can afford. Let's say 2%. That's $10,000. We'll put down the other 18% or $90,000. Then we'll go get a mortgage together for the remaining 80%. On the surface, it sounds like a miracle. You get into the house of your dreams for a fraction of the traditional cost. Your monthly payment is lower because you're only paying the mortgage on your share, plus a small fee or rent to the company for the portion they own. You get to live in the house, build equity as the value goes up, and you can buy more shares from the company over time, eventually aiming to own the whole thing. It's homeownership on a payment plan. The brilliant part is that it opens doors that were slammed shut for millions of people. But here's where it gets unsettling. Who really owns your home? You own a piece. A corporation owns the other piece. You're not just a homeowner. You're a business partner with a faceless entity whose primary goal is not your family's well-being, but its return on investment. What happens if you want to renovate the kitchen? You might need your corporate partner's approval. What happens when you want to sell? You have to navigate a complex legal agreement that dictates how the profits are split and who has the final say. And the most terrifying question of all: what happens if that startup, that co-owner of your home, goes bankrupt? Suddenly, your home equity is tied up in a bankruptcy proceeding, and a court-appointed trustee is deciding the fate of your largest asset. You traded the simplicity of a traditional mortgage for a complex, entangled relationship where you no longer have complete control over your own home. This blurring of lines between renting and owning is a theme, and it leads us directly to the next trend: the institutionalization of rent-to-own. Now, rent-to-own has been around for ages, often with a shady reputation. But this is different. This is rent-to-own 2.0, backed by billions in venture capital. Companies like Home Partners of America or Divvy Homes have turned it into a sleek, tech-driven process. Here's the pitch. You find a home on the open market that you want to buy, but you can't get a mortgage yet. Maybe your credit score is a little too low, or you haven't saved enough for a down payment. So, this company swoops in, buys the house for you in cash, and then rents it back to you for a period of 1 to 3 years. Part of your monthly rent payment goes toward a savings account for your future down payment. The real hook, though, is the option agreement. From day one, you lock in a purchase price for that house. Let's say the company buys it for $400,000 today. They might give you the right to buy it from them in 2 years for $430,000. The idea is that you get to live in your future home now while you work on your finances. And if the housing market goes crazy and that home is worth $500,000 in 2 years, you still get to buy it for the agreed-upon price of $430,000. You capture all that extra appreciation. It gives people a clear path, a finish line. The unsettling part? It's a massive gamble. What if the market doesn't go up? What if it goes down? If that $400,000 house is only worth $380,000 in 2 years, you're still legally locked into the option to buy it for $430,000. Your choice is to either walk away, forfeiting all the extra money you paid into your savings and the option fee, or knowingly overpay for the house by $50,000. And what if, after 2 years of diligently paying your rent, you still can't qualify for a mortgage? Maybe you lost your job, had a medical emergency, or interest rates shot up. You're out of luck. The company keeps your savings and you have to move out. You were so close to owning you felt like an owner, but in the end you were just a tenant with a very expensive and ultimately useless contract. But perhaps the most insidious evolution in the mortgage product itself is the quiet resurgence of shared appreciation mortgages, or SAMs. This is where the lender stops being just a lender and becomes an investor in your home's future value. The deal is incredibly seductive. The bank will offer you a significantly lower interest rate, maybe a full point or two below the market rate. In a high-rate environment, that could save you hundreds, even $1,000 a month on your payment. It makes an unaffordable home suddenly seem affordable. The catch, the fine print, is that in exchange for that lower rate, you give the bank a percentage of your home's future appreciation. Let's say you buy a home for $500,000. The bank gives you a low rate, and in return, you agree to give them 25% of any profit when you sell. 5 years later, you've done some renovations, the market has been kind, and you sell the house for $700,000. That's a $200,000 profit. Before you see a dime, you have to write a check to your mortgage lender for $50,000. That's the price you paid for 5 years of lower monthly payments. Think about what this does to the fundamental relationship. Your lender now has a vested interest in your home appreciating as much as possible, because they get a cut. But more importantly, you are essentially selling a piece of your future financial success for a little bit of relief today. You're betting that the long-term gain you're giving away won't be worth that much, while the lender is betting that it will. And who do you think has better economists and analysts on their side? This isn't just a loan anymore. It's a futures contract on your own home. Fractional ownership, institutional rent-to-own, shared appreciation. These aren't just niche products. They are fundamental shifts in the DNA of the mortgage. They are all designed to chip away at the traditional model of ownership to make a home accessible in a broken market. They offer a solution, but at the cost of simplicity, control, and future wealth. You're no longer just a borrower. You're a partner, a tenant, an investment vehicle. And this transformation is being powered by an invisible force, a revolution happening behind the scenes in the lender's office. Because the decision of who gets offered these new, complex products, and under what terms, is no longer being made by a human loan officer sitting at a desk. It's being made by an algorithm that knows more about you than you can possibly imagine. This black box, this digital brain, doesn't just look at your credit score and your pay stubs. That's the old way. That's checkers. This is three-dimensional chess. The algorithms being deployed today by fintech lenders and increasingly by the big traditional banks are built on a foundation of machine learning. They are designed to do one thing: predict risk with a level of accuracy a human underwriter could only dream of. And to do that, they need data. Not just the little data, all of it. Think about your digital footprint. Every online purchase you've ever made, the subscriptions you pay for every month, from your gym membership to your streaming services, the regularity of your utility payments, the balance you keep in your checking account, not just on the day you apply, but the average over the last 2 years. It can see the fluctuations, the inflows from your paycheck, the outflows for rent, for groceries, for that late-night pizza order. It's analyzing patterns of financial behavior. Are you a meticulous saver? Or do you live paycheck to paycheck, your account balance hitting zero the day before payday? Goes deeper. Some of these more advanced systems can be given permission to analyze your educational background, your employment history on platforms like LinkedIn, how often you switch jobs, the industries you work in. They can analyze your rental payment history, something that never used to touch your credit report, but is now seen as a powerful predictor of mortgage payment reliability. If you've paid your landlord on time every month for 5 years, that's a data point, a very valuable one. This is the world of alternative data, and it's the single biggest change in lending in 50 years. The goal, according to the companies building these systems, is to create a more holistic, a more complete picture of you as a borrower. The FICO score, they argue, is a blunt instrument. It's backward-looking and can penalize people for a single past mistake, or exclude people who are perfectly creditworthy but are credit invisible. They don't have credit cards or car loans, so the traditional system doesn't know what to do with them. Imagine a young freelance graphic designer. Her income is variable. She doesn't have a W-2 from a big corporation. A traditional loan officer might look at her file and see inconsistency, see risk. The application gets stamped denied. But an AI might see something different. It might see consistent, on-time rent payments for 7 years. It might see a steadily growing balance in her business savings account. It might see regular payments from a diverse client base, indicating a stable business, even if the monthly income fluctuates. The algorithm connects these disparate dots and sees a pattern of responsibility. It sees a low-risk borrower where a human saw a high-risk one. And just like that, an application that was once a dead end becomes an approval. This is the promise of AI in lending. Speed and access. Decisions that used to take weeks of paperwork, phone calls, and manual review can now be rendered in minutes. You can apply for a mortgage on your phone while sitting on your couch and have a pre-approval before you've finished your coffee. For millions of Americans who have been locked out of the traditional credit system, immigrants, young people, gig economy workers, this technology could be the key that finally unlocks the door to homeownership. Sounds like a perfect, data-driven meritocracy, a system where it doesn't matter who you know, what you look like, or where you come from. All that matters is what the data says about your ability to pay back a loan. But there is a dark side to this automated revolution, a ghost in the machine, because these algorithms, for all their processing power, are not truly intelligent. They don't understand context or fairness or history. They are learning machines, and they learn from the data we feed them. And what happens when the data we feed them is biased? The entire history of lending in the United States is riddled with human bias. Decades of discriminatory practices like redlining, where banks would literally draw red lines on a map around minority neighborhoods and refuse to lend there. Even after these practices became illegal, their echoes persisted in human decision-making. Now we are taking decades of this historical loan data that reflects all of those past societal biases, and we are feeding it into these new powerful algorithms as the ground truth. We are teaching the AI to think like the system we're trying to fix. The algorithm might learn, for example, that applicants from a certain zip code have historically had a higher default rate. It doesn't know that this zip code was a historically redlined neighborhood, starved of investment for generations, creating a cycle of economic disadvantage. The AI doesn't see the injustice. It just sees a statistical correlation, a pattern, and it learns to replicate it. It learns that applicants from that zip code are riskier, and it starts automatically denying them or offering them worse rates. This is algorithmic bias. It's redlining but supercharged with technology. It's discrimination at the speed of light, and on a scale that's almost impossible to police. And the scariest part? It's all happening inside a black box. If a human loan officer denies your application, you can ask why. They have to give you a reason. Under the Equal Credit Opportunity Act, you have a right to an explanation. But how do you ask an algorithm? In many cases, even the lenders using the software don't fully understand how it reaches a specific conclusion. The complex web of variables and correlations is so dense that it's indecipherable to the human mind. The answer you get back is simply, "The computer said no." This creates a terrifying new problem of accountability. Who is responsible when the algorithm gets it wrong? Is it the bank that used the software? The tech company that designed it? The data brokers who supplied the information? This lack of transparency is a breeding ground for a new, insidious form of discrimination. One that's harder to see, harder to prove, and therefore much harder to fight. So we stand at a crossroads. On one path, AI-driven lending creates a faster, more inclusive, and more efficient market that gives more people a shot at the American dream. On the other, it creates a high-tech dystopia, where our financial futures are decided by biased, unaccountable algorithms, perpetuating the mistakes of the past under a veneer of objective, data-driven neutrality. The technology itself is not good or evil. It is simply a tool. The real question is, how are we choosing to use it? And what safeguards are we putting in place to protect the consumer? Because right now, the digital version of you, your data double built from your online habits, your financial transactions, and your social media presence is being judged. And that judgment could determine whether you ever get to own a home. This isn't some far-off future. It's happening right now in loan applications across the country. And the rules of this new game are still being written. The problem is, most of us don't even know we're playing. And even fewer of us understand how the new digital gatekeepers are deciding who wins and who loses. So who are these new digital gatekeepers? They aren't people sitting in a corner office, stamping files with approved or denied. They are algorithms. Complex, self-learning lines of code that are quietly and irrevocably reshaping the entire landscape of American homeownership. To understand their power, let's talk about a woman named Maria. Maria is a freelance web developer in Austin, Texas. For the last 5 years, she's been incredibly successful. She makes good money, often clearing 6 figures a year. She's saved up a substantial down payment, over 20% for a modest 2-bedroom house she's had her eye on. By all traditional measures of success, Maria is thriving. But in the eyes of a traditional mortgage lender, Maria is a ghost. Her income isn't a neat, predictable W-2 salary. It comes in waves. A big project might pay her $30,000 in 1 month, followed by 2 months of smaller retainers totaling just $5,000. She doesn't have a 2-year consistent employment history with a single company. She has a 5-year history of successfully running her own business, juggling dozens of clients. When Maria walked into a big, traditional bank, the loan officer was polite but dismissive. He looked at her tax returns, saw the fluctuating income, the lack of a corporate pay stub, and shook his head. The bank's rigid, outdated underwriting system couldn't make sense of her. Saw risk, saw instability. To the bank, Maria's freelance success was a liability, not an asset. She was denied, not because she couldn't afford the house, but because her financial life didn't fit into a pre-approved 50-year-old box. This is the exact problem that the new digital gatekeepers were designed to solve. Feeling defeated, Maria heard about a new online lender, one of those slick, app-based companies that promises a mortgage decision in minutes, not weeks. Skeptical but desperate, she downloaded the app. Instead of asking for pay stubs, it asked for something far more intimate: permission to securely link to her bank accounts, her business account, her personal checking, her savings. She hesitated for a moment, then clicked authorize. What happened next is the revolution. The lender's algorithm didn't just see 2 years of tax returns. It ingested 5 years of raw financial data in seconds. It saw every client payment, every deposit, every transfer to her savings account. It didn't see an unstable freelancer. It saw a consistent, positive cash flow. It saw that even in her slow months, her account balance never dipped below a healthy threshold. It analyzed her spending habits, noting that she paid her rent, her utilities, and her credit card bills on time, every single time. It was a complete, holistic, real-time financial colonoscopy. The algorithm wasn't looking for a W-2. It was looking for a pattern of responsibility, and it found one. A pattern the human loan officer, constrained by his checklist, had completely missed. 24 hours later, Maria got a notification on her phone. She was pre-approved, at a competitive rate. Maria's story is becoming more and more common for millions of Americans in the gig economy, for small business owners, for anyone with a non-traditional financial life. These AI-powered systems are a godsend. They are cracking open a door that the old guard had bolted shut. This new underwriting model is called cash flow lending, and it's based on a simple, powerful idea that the money you actually have and how you manage it is a better predictor of your ability to pay a mortgage than what your employment status says on a form. These algorithms look at what's called alternative data. It's a friendly-sounding term for a universe of information that lenders never used to touch. Your rent payments, for example. For decades, paying your landlord $1,000 on time every month for 10 years meant nothing for your creditworthiness when it came to buying a home. But now, services are emerging that report your rental history to the credit bureaus, and more importantly, to these new lending algorithms. They see a long history of on-time rental payments as proof that you can handle a monthly mortgage payment. Same thing with your utility and cell phone bills. Pay them on time? That's another positive data point. The algorithm is constantly building a mosaic of your financial habits. Every little piece of data is a tile. For people with a thin file, meaning they don't have a long history of using traditional credit like loans or credit cards, this is a game changer. It allows them to build a profile of trustworthiness from their everyday financial life. But here is where the story takes a darker, more complicated turn. This immense power to see everything, to analyze everything, comes with enormous risks. Because the very thing that makes the algorithm so powerful, its ability to see patterns we can't, is also what makes it so dangerous. These algorithms learn from data. They are trained on millions of past loan applications and their outcomes. The goal is to teach the machine what a good loan looks like and what a bad loan looks like. But what if the historical data itself is biased? For decades, lending in America has been plagued by systemic biases, both conscious and unconscious. Practices like redlining explicitly denied loans to people in minority neighborhoods. Even after being outlawed, its legacy persists in the data. Certain zip codes, certain demographic profiles were historically considered riskier, not for financial reasons but for discriminatory ones. Now, imagine you feed an algorithm millions of these historical loan files. The machine doesn't have a conscience. It doesn't understand the history of civil rights. It only understands patterns. It might learn that applicants from a certain zip code have a slightly higher historical default rate. So, it starts downgrading the score of every new applicant from that zip code. The algorithm hasn't been programmed to be racist or classist. It's just been programmed to find the most profitable patterns. And in doing so, it can accidentally create a new, ruthlessly efficient form of digital redlining. It launders historical human bias through the clean, sterile language of code, making it seem objective and fair when it's anything but. This isn't a hypothetical problem. Regulators are scrambling to understand and police this. How do you audit an algorithm that is constantly changing and learning? How do you prove that a decision was discriminatory when the lender themselves might not fully understand the thousands of variables the AI used to make its choice? This is known as the black box problem. The logic of the most advanced AI can be so complex that even its own creators can't fully retrace its steps to see exactly why it approved one person and denied another. You can get a denial, and the reason given might be a vague, computer-generated code that means nothing to you. You can't argue with it. You can't reason with it. You can't explain the context that the data might have missed. So while this new world opens doors for people like Maria, it might be silently closing them for others, reinforcing old biases with a new and terrifying efficiency. The digital gatekeeper is fast, it's powerful, but it has no soul. It has no capacity for understanding context, grace, or the nuances of a human life that can't be quantified in a data point. The challenge for every single one of us is to learn how to navigate this new terrain. We have to become more conscious of our digital financial footprint. Knowing that your bank account is being analyzed means that overdrawing your account, even by a few dollars, could be a red flag. It means that having consistent, automated savings transfers, no matter how small, can be a powerful positive signal. It means using those services that report your rent and utility payments isn't just a gimmick. It's a strategic move in this new game. We are all being scored all the time by systems we can't see. And those scores are increasingly determining our access to the American dream. We've just pulled back the curtain on how these AI gatekeepers decide who gets a loan. But the revolution doesn't stop there. The technology isn't just changing the application process. It's starting to change the very nature of the loan itself. The fundamental product that has been the bedrock of American homeownership for nearly a century might be on the verge of a radical transformation. And the 30-year fixed-rate mortgage could be the first casualty. To understand why, you have to look at the 30-year fixed-rate mortgage not as a product for a homebuyer, but as an investment for a global financial institution. For decades, it was the perfect investment. Stable, predictable, and backed by the most reliable asset on earth, the American home. Lenders would originate the loan, sell it to investors, and repeat the process, collecting fees along the way. It was a beautifully simple money-making machine. But the economic earthquake of the last few years has shattered that machine. The core problem is something called interest rate risk, and it has two deadly heads: prepayment risk and duration risk. For years, the big fear for lenders was prepayment risk. When interest rates fell, every homeowner with a brain would refinance to a lower rate. The lender, who thought they had a reliable 5% return locked in for 30 years, would suddenly get all their money back. Now they had to reinvest that cash in a new market where the going rate was only 3%. They lost out on decades of expected profit. That was the game. But now the game has flipped. The monster in the closet is duration risk. Imagine you're a bank. In 2021, you lent out $100 million in mortgages at 2.8%. That money is now locked up in an asset that pays you less than 3% per year. Meanwhile, the interest rate you have to pay just to borrow money overnight from the Federal Reserve is over 5%. You are losing money every single day on your safest assets. You're paying more for your capital than your capital is earning. Scale that across trillions of dollars in the US financial system, and you see the crisis. The 30-year fixed-rate mortgage has turned from a golden goose into a lead weight, dragging down balance sheets across the country. This isn't just a problem for banks. It's a problem for the entire housing market. It has created a phenomenon that economists are calling the golden handcuffs. There are tens of millions of American homeowners sitting on mortgages with rates of 2, 3, or maybe 4%. They are shackled to their homes by an interest rate they will likely never see again in their lifetime. Think about it from a human perspective. A family bought a 2-bedroom starter home in 2020. They had a baby. Then they had another. They are bursting at the seams. In any normal market, they would sell their home, take their equity, and buy a bigger place in a better school district. But they can't. Their current mortgage payment on a $300,000 loan at 3% is about $1,265 a month. A new, bigger house for $500,000 at a 7% interest rate would have a payment of over $3,300 a month. Their payment would nearly triple just to make a logical move for their family. So they stay put. They renovate the basement, they turn the dining room into a nursery, they make it work. They are trapped. This effect, multiplied by millions, has frozen the housing market. Inventory is at historic lows not just because of a lack of new construction, but because existing homeowners are refusing to sell. Why would they give up the best inflation-proof asset they will ever own? This lack of supply, in turn, keeps prices artificially high for first-time homebuyers, creating a vicious cycle of unaffordability. The very instrument designed to promote homeownership, the 30-year fixed, is now the primary obstacle for an entire generation. The market cannot function like this forever. Something has to give. And that's why we're seeing a quiet but powerful push to fundamentally reshape the American mortgage. The goal is to create products that share the risk more evenly between the borrower and the lender. The most obvious alternative is the adjustable rate mortgage, or ARM. Now I know what you're thinking. The ARM was the villain of the 2008 financial crisis. It was the ticking time bomb that blew up the global economy. But the ARMs of today are a different beast. Post-2008 regulations like the Dodd-Frank Act put serious guardrails in place. Underwriting is far stricter. Lenders have to qualify you based on the fully indexed rate, not just the low introductory teaser rate. And there are caps on how much the rate can increase over the life of the loan. A 7-to-1 or a 10-to-1 ARM, for example, gives you a fixed rate for the first 7 or 10 years, a period during which many people move anyway. In exchange for taking on the risk that rates might be higher a decade from now, you get a significantly lower interest rate today. It's a calculated risk, but for many buyers, it's a risk that could make the difference between buying a home and being permanently priced out. Lenders love them because it shifts that long-term duration risk off their books and onto the borrower. But ARMs are just the beginning. The real innovation is happening with ideas that challenge the very structure of how we tie a loan to a property. Two of the most fascinating concepts are portable mortgages and assumable mortgages. Let's start with portable mortgages, which are common in countries like Canada and the UK but practically unheard of here. A portable mortgage is exactly what it sounds like. You can take your mortgage and its fantastic interest rate with you when you move. Imagine our family in the 2-bedroom house with their 3% mortgage. With a portable mortgage, they could sell their home and buy that bigger $500,000 house. They would simply port their existing $300,000 loan balance over to the new property and only take out a new, smaller loan for the $200,000 difference at current market rates. This would instantly break the golden handcuffs and get the housing market moving again. So why don't we have them in the US? The main reason is the complexity of our secondary mortgage market. Our system is built on standardized, easily tradable mortgage-backed securities. A portable mortgage with its blended rates and custom terms is much harder to package and sell to investors. But the pressure to solve the lockdown is so immense that financial engineers are working overtime to figure out how to make this a reality. Then there's the even more immediate solution: the assumable mortgage. This is where the buyer of a home literally takes over the seller's existing mortgage. The loan's original interest rate, balance, and terms all transfer to the new owner. This isn't a new idea. FHA, VA, and USDA loans are already assumable. But the vast majority of loans, conventional loans backed by Fannie Mae and Freddie Mac, are not. Think about the power of that. If you're a seller with a 2.9% mortgage, your loan itself becomes one of the most valuable features of your home. You're not just selling a house. You're selling a house attached to an incredibly cheap source of financing. A buyer would be willing to pay a premium for your property just to get access to that loan. Suddenly, houses with low-rate assumable mortgages would have a massive competitive advantage. It would create a two-tiered market, but it would also inject a huge amount of liquidity and incentive for people to sell. The push to make conventional loans assumable is growing louder every day in Washington, as it's seen as one of the fastest ways to unstick the frozen market. Between re-engineered arms, the dream of portable mortgages, and the powerful potential of assumable mortgages, the landscape of home financing is on the brink of its biggest change in generations. The one-size-fits-all model of the 30-year fixed mortgage is being challenged from all sides. It served a purpose in an era of stable, declining interest rates. But in our new world of volatility and inflation, the market is demanding flexibility, shared risk, and innovation. The question is no longer if the American mortgage will change, but how it will change, and who will be the winners and losers. But changing the loan products is only half the battle. The real revolution is happening behind the scenes, in the very code that approves or denies your loan. The gatekeepers to homeownership are no longer just people. They're algorithms, and what they're looking for in a borrower is about to change everything. For decades, the path to a mortgage was a narrow, well-trodden road. You needed a FICO score above a certain number, a debt-to-income ratio below a certain percentage, and 2 years of steady W-2 income from a single employer. It was a rigid, unforgiving checklist. If you were a freelancer, a small business owner, or part of the booming gig economy, that checklist often worked against you. Your income, even if substantial, was seen as unpredictable, unstable. You were a risk. The old model wasn't built for the modern economy. It was a snapshot, not a story. It measured stability in a world that is increasingly fluid. But the new algorithmic gatekeepers? They're not looking for a snapshot. They're watching the entire movie of your financial life. These new underwriting systems, powered by machine learning and artificial intelligence, are voracious. They don't just look at 3 or 4 data points. They can analyze thousands, painting a high-definition picture of your financial health that the old FICO score could only dream of. Think of it this way. A traditional underwriter was like a security guard checking your ID at the door. They look at your name, your picture, your date of birth, and make a quick judgment. An AI underwriter is like a master detective who has been observing you for months. They know your habits, your patterns, your consistency, and they can predict your future behavior with astonishing accuracy. So what clues are they looking for? The first and most revolutionary is cash flow analysis. Instead of demanding a W-2, these platforms can, with your permission, securely link to your bank accounts. They don't just see a single paycheck number. They see every dollar coming in and every dollar going out. They see the frequency of payments from your clients. They see that even though your income wasn't the exact same every month, you consistently maintained a positive cash flow. They see that you managed your money well, building a savings buffer during high-income months to coast through the lower ones. For a freelance web developer or an Etsy shop owner, this is the difference between a rejection letter and a set of house keys. The algorithm doesn't see unstable income. It sees a successful, functioning business model. But it goes so much deeper. These systems are gobbling up what's called alternative data. This is the financial information that the big three credit bureaus largely ignored for years. Did you pay your rent on time every single month for the last 5 years? That's a huge indicator of reliability, arguably more important than a credit card payment, yet it never touched your FICO score. Now, lenders are using services that verify rental history. Same goes for your utility bills, your cell phone bill, even your Netflix subscription. A long history of consistent, on-time payments for these services tells the algorithm that you are a responsible consumer, even if you don't have a long history of traditional credit. It's a democratization of data, allowing a broader range of your financial life to speak on your behalf. Let's imagine a borrower named Sarah. Sarah is a 28-year-old graphic designer with a thriving freelance business. She makes over $100,000 a year, but it comes from a dozen different clients in fluctuating amounts. She has a thin credit file. Just one student loan she's paying off and a single credit card she uses for business expenses. She's been paying $2,000 a month in rent, on the dot, for 4 years. Under the old system, Sarah is a nightmare for an underwriter. No W-2, variable income, thin credit file. Denial almost certain. But Sarah applies to a modern tech-driven lender. She securely links her bank accounts. The algorithm scans 24 months of her transaction history. It sees the variable income, but it also sees the pattern. An average monthly income of over $8,000 and a consistent savings rate of 15%. It verifies her rental payment history through a third-party service, confirming a perfect record. It even notes her on-time payments to her cell phone provider and Adobe for her creative software subscription. The algorithm doesn't see a risk. It sees a low-debt, high-earning, responsible individual with a proven ability to manage fluctuating cash flow. Sarah isn't just approved. She's approved for a prime loan with a competitive rate. The algorithm understood the story of her financial life, not just the outdated chapter headings. This is the incredible promise of AI in lending, to open the doors of homeownership to millions of deserving Americans who were previously locked out by an antiquated system. It's about looking at the whole person, not just a 3-digit number. It's a shift from exclusion to inclusion powered by data. It sounds like a perfect utopian solution to a decades-old problem. But there's a shadow lurking behind this bright, technological dawn. What happens when the detective makes a mistake? When a human underwriter denied you, you could call them. You could write a letter, explain the circumstances, provide more context. You could appeal to another human being. How do you appeal to an algorithm? Who do you call when the computer says no? If a data error on your bank statement or a miscategorized transaction leads to a denial, you might find yourself screaming into a void, with no one to hear you. And there's an even more sinister question. These machine learning models are powerful because they learn from data. But what data are they learning from? They are trained on decades of historical loan data. Data that is riddled with a long and ugly history of human bias. Redlining, the discriminatory practice of denying services to residents of certain areas based on their race or ethnicity, may have been outlawed, but its ghost lives on in the data. An algorithm, in its cold, impartial quest for patterns, might learn that applicants from certain zip codes have historically had higher default rates. Doesn't know why. It doesn't understand the history of disinvestment or systemic inequality. It just sees a pattern in the numbers. And so, without incredibly careful and ethical programming, the algorithm could inadvertently create a new, insidious form of digital redlining. It could learn to associate certain names, certain schools, or even certain spending habits with higher risk, effectively discriminating against people without ever being explicitly told to. It would be a bias baked into the code, invisible to the applicant and almost impossible to prove. The very tool designed to create fairness could become an engine for a new, more efficient, and more opaque form of discrimination. We are standing on a knife's edge. On one side is a future where homeownership is more accessible and equitable than ever before. On the other is a future where the gatekeepers are invisible, unaccountable black boxes, perpetuating the biases of the past with terrifying efficiency. The technology itself is neutral. The question is, who is building it, what are their motives, and what safeguards are being put in place to protect the consumer? The future of your mortgage, and perhaps the very shape of our communities, depends on the answer. And that answer is being written right now, not in a government building in Washington, but in the code of 1,000 startups and the policies of 100 banks. It's a battle for the soul of the home buying process. On one side, you have the drive for ultimate efficiency. A world where you can get approved for a $500,000 loan with a few taps on your phone, faster than you can order a pizza. The appeal is undeniable. It's frictionless. It's fast. But on the other side, you have the critical need for guidance, for empathy, for a human being who can look at your unique financial picture, your freelance income, your recent job change, your student loan debt, and see a person, not just a data set. Because a mortgage isn't like buying a new phone. There's no return policy. This is the single largest financial decision most people will ever make. And getting it wrong can have consequences that echo for decades. The ultimate trend, the one that underpins all the others, is this search for a new equilibrium. A balance between the power of technology to streamline and the irreplaceable value of human expertise to guide. The loan officer of the future won't be a paper pusher. They'll be a strategist, an advisor armed with powerful AI tools to model scenarios for their clients in real time. They'll be the ones who can explain why the algorithm suggested a 15-year ARM instead of a 30-year fixed, and whether that actually makes sense for your family's long-term goals. So, after this deep dive into rates, inventory, creative financing, and technology, what does this all mean for you right now in the real world? Let's break it down. If you are a first-time homebuyer, your mantra should be preparation and education. The days of casually browsing Zillow on a Sunday and getting pre-approved on a Monday are on pause. Your first step isn't calling a realtor. It's becoming the most qualified, educated buyer you can possibly be. This means getting your credit score into the best possible shape. We're not talking about a good score. In this market, you need an excellent score to unlock the best rates. Pay down high-interest debt. Scrutinize your credit report for errors. Save aggressively, not just for the down payment, but for closing costs and a robust emergency fund for when that water heater inevitably breaks a month after you move in. And you need to become an expert on assistance programs. Research FHA loans, VA loans, and USDA loans if you qualify. But go deeper. Look into state and local down payment assistance programs. These are often grants or forgivable loans that can dramatically reduce your upfront cash requirement. They're not always well advertised, but they are out there. Your mission is to find them. You have to be more resourceful, more prepared, and more resilient than buyers were 5 years ago. The barrier to entry is high, but it's not insurmountable for those who do the work. Now, for those of you who are current homeowners, you are in a completely different position. You're likely sitting on a mountain of home equity, thanks to the massive run-up in home prices. You hold the cards, but with great equity comes great responsibility. And a lot of options. The temptation to do a cash-out refinance to pay for a new kitchen or consolidate debt is strong, but you have to do the math with extreme prejudice. Tapping that equity means giving up your historically low interest rate from 2020 or 2021 and replacing your entire mortgage with a new, much higher rate. In many cases, this is financial malpractice. Instead, the smarter tools in your toolbox are the Home Equity Line of Credit, or HELOC, and the Home Equity Loan. These act as a second mortgage, allowing you to borrow against your equity without touching your primary, low-rate mortgage. A HELOC works like a credit card. You can draw from it as needed. A home equity loan gives you a lump sum upfront. Both will have a higher interest rate than your primary mortgage, but it only applies to the amount you borrow, not your entire loan balance. This is the strategic way to leverage your equity in a high-rate environment. Don't trade a 2.8% rate for a 7.2% rate just to get $50,000 in cash. It's almost never worth it. And what about real estate investors? The game has fundamentally changed. The simple buy, rent, and watch it appreciate strategy that worked for the last decade is now a minefield. Positive cash flow is incredibly difficult to find in most major markets. So the trend for savvy investors is a flight to creativity and precision. They're not just looking at cities, they're looking at specific zip codes, even specific neighborhoods, where rental demand is outpacing supply. They're exploring strategies like house hacking, buying a duplex or triplex, living in one unit, and renting out the others to cover the mortgage. They're looking at medium-term rentals for traveling nurses and corporate contractors, a niche that can offer higher returns than traditional long-term leases. The era of easy money in real estate investing is over. The era of the smart, data-driven, and creative investor is just beginning. Ultimately, navigating the U.S. mortgage market today is less about timing the market and more about understanding the market. Trying to predict whether rates will be a quarter point higher or lower in 6 months is a fool's errand. It's noise. The signal is your own financial situation and your long-term goals. The fundamental questions haven't changed. Can you comfortably afford the monthly payment? Do you plan to live in the home for at least 5 to 7 years to ride out any short-term market fluctuations? Does this home serve the needs of your life, your family, your career? These are the timeless truths that get lost in the panic of daily headlines about the Fed. The American housing landscape is in the middle of a great reset. It's a challenging time, filled with uncertainty and affordability hurdles that are genuinely painful for millions of people. But it's also a necessary correction. It's forcing a return to sound financial principles. It's weeding out the speculation and rewarding the prepared. And it's spurring innovation, from new financing models to technologies that will, hopefully, make the entire process more transparent and accessible for the next generation. The house you buy is more than an asset on a balance sheet. It's the backdrop for your life's most important moments. It's the place you come home to after a long day. It's a cornerstone of your community. The mortgage that makes it possible is therefore more than a loan. It's a tool for building a life. And like any powerful tool, it demands to be understood, respected, and wielded with a clear and deliberate strategy. Don't be a passenger in your own financial journey. Take the wheel. Educate yourself, ask the hard questions, and build a team of trusted advisors. Because the American dream isn't a destination you arrive at with a single key turn. It's a structure you build decision by decision, and the mortgage is the foundation. Choose to build it on solid ground.